Nikkei 225 just lost the floor at 62,739. The index dropped nearly 1% on the session, smashing straight through a support that had held for 6 consecutive trading days. But before you hit the panic button and start dumping Japanese equities, you need to see the structure that is forming right now. This is the exact kind of zone where false breakdowns turn into the most violent reversals, or where the trap becomes the grave. There is one danger zone and one hidden opportunity today, and I will show you both. Stay until the end, because I am giving you 3 exact entry and exit levels you can use immediately, including the single number that decides whether the next 800 points are up or down. Let's land the instant market verdict. Right now, the Nikkei 225 is in a short-term pressure cooker, but it is sitting on top of a much larger bullish architecture. My session bias is a cautious fade of this breakdown, meaning I am looking for signs that this dip below 62,739 is a liquidity grab, not a genuine trend change. However, I will not marry that bias. There is one invalidation level that proves it wrong, and that number is 61,835. A 4-hour close below 61,835 would shred the daily bull structure and open a trapdoor towards 60,000. Write this number down now. If we break 61,835 today, the whole structure shifts from buy the dip to sell the rally. Commit that to memory. Now, pull up your charts and let me walk you through the technicals exactly the way I see them on my screens. We start top down, because timeframes always tell you who is in control. On the weekly chart, the Nikkei 225 is in a roaring uptrend that began in early 2023. The 20-week moving average is sloping up sharply around 59,800, the 60-week is at 57,200, and the 200-week sits far below at 48,000. That is a mile away. The weekly MACD histogram is still positive, and the signal line is rising, which means the long-term trend remains a strong buy. So whatever is happening today, the heavy artillery is still pointed north. Drop to the daily chart. Here is where the narrative tightens. The daily trend is flashing strong buy as well. Price is above the 20-day moving average, which today comes in at 61,840, almost exactly our structural invalidation. The 60-day moving average is at 60,400, and the 200-day is at 58,200. All three are aligned higher, and price is trading above them. This is the textbook definition of a bull trend. The daily MACD, however, is telling a slightly different story. The MACD line is still above the signal line, but the histogram bars are shrinking. For the 4th consecutive day, buyers are not adding momentum, they are just holding the line. This subtle loss of energy is exactly why the 62,739 support finally gave way. Now, drill into the 4-hour time frame, because this is where today's drama was scripted. The 4-hour chart printed a massive bearish engulfing candle that swallowed 4 previous candles and crashed straight through 62,739. That level was the floor of a 4-hour consolidation channel that had contained price for 7 sessions. The breakout is real in terms of price, but look at the moving averages. The 4-hour 20-period moving average is now curling down and sits at 63,200. The 60-period on the 4-hour is flattening at 62,900. Price is trading below both, which means short-term momentum belongs to the sellers. The 4-hour MACD has crossed bearishly, with the fast line accelerating below the signal line. This is not the time to blindly buy a dip yet. The momentum structure needs repair. But here is where it gets interesting, and this is what most traders will miss. On the 60-minute chart, the relative strength index plunged to 28 during the drop and has now bounced back above 30. We are seeing a classic bullish divergence forming on the 1-hour MACD. Price printed a lower low at 62,500, but the MACD histogram printed a higher low. The momentum behind the selling is weakening at the very moment the crowd feels maximum fear. That is the signature of a trap. The 60-minute 20-period moving average is at 62,900 and is acting like a magnetic ceiling right now. If price can retake that level and then reclaim the 4-hour breakdown point at 62,739, the trap is confirmed, and the short sellers will be scrambling to cover. Let me give you the hard numbers. Today's pivotal resistance is 62,739. That is the old support, now turned resistance, and the line in the sand. Above that, the next resistance is 64,125, which is the April swing high and a major level that has rejected price 3 times in the last 2 months. Above that, 64,608, the year-to-date peak. On the downside, the immediate support below the current price of 62,654 is the next structural floor at 61,835. That is the confluence of the daily 20-day moving average, the top of the previous range breakout from early March, and the edge of the weekly value area. If that goes, the bull trend is in serious trouble. Now, before we go further, we must do the cross-asset integrity check, because the Nikkei never moves in isolation. I need you to pull up your US dollar to Japanese yen chart right now. The two are locked in a negative correlation dance that is almost mechanical. Over the last 20 trading sessions, the correlation coefficient has been minus 0.85. When the yen strengthens, the Nikkei falls, and when the yen weakens, the Nikkei rallies. That is exactly what happened today. US dollar to Japanese yen slid from 133.20 down to 131.80, driven by a fresh plunge in US yields overnight and a summary of opinions from the Bank of Japan that hinted at a possible tweak to yield curve control. As the yen ripped higher, exporters got hammered, and the Nikkei 225 dropped nearly 600 points. But here is the intervention ghost that hangs over every trade. The Bank of Japan has drawn a line in the sand around the 130 handle on dollar-yen. If US dollar to Japanese yen accelerates toward 128, the Ministry of Finance is highly likely to step in with verbal intervention first, and potentially actual yen selling intervention if the move becomes disorderly. For the Nikkei, that is a potential rocket fuel moment. A sudden yen weakening intervention would send Nikkei futures screaming higher, trapping all the late shorts. So, as you trade this Nikkei breakdown today, keep one eye glued to US dollar to Japanese yen. If dollar-yen finds a bid and reclaims 132.50, the Nikkei breakdown likely fails. If dollar-yen cascades below 131.20, then the Nikkei 61,835 support becomes a very real target. The 24-hour headline tells part of the story. Japan stocks were lower at the close of trade. Nikkei 225 down 0.95%. But the real engine was the jump in Japanese government bond yields. The 10-year JGB yield popped above 0.55% after the BOJ summary mentioned that inflation expectations are rising, and the central bank needs to maintain flexibility. That narrowing yield differential between the US and Japan pulled the yen bid, and equities sold off. This is a yield-driven move, not a pure risk-off event. Global risk appetite is actually holding up. The S&P 500 futures are flat, and Bitcoin is stable. So, this Nikkei drop is a local Japanese rate story, not a global meltdown. Now, what is the 1 to 2 week directional lean? My base case is that this Nikkei dip is a buying opportunity within a larger uptrend, but only if the price action confirms it. The bull case is that the index holds above 61,835 and eventually reclaims 64,125, resuming the grind higher. The bear case, triggered by a close below 61,835, targets 60,000 and possibly the 200-day moving average near 58,200. The event that will decide this in the coming days is the US ISM manufacturing data tomorrow and, more importantly, any verbal comment from Japan's top currency diplomat. That is the catalyst that can create a 500-point reversal in an hour. Stay nimble now. Let's move into the part of the video most people will skip, but this is where money is made. Keep watching. I am going to give you 3 exact trade strategies for today's Nikkei 225, each with precise triggers, stops, and reward-to-risk ratios. Strategy number 1, I call this the sniper, for conservative traders who want a high probability confirmation before risking a single yen. The trigger here is a failed breakdown, meaning you do not act until the market proves the trap. We wait for a 4-hour candle close above 62,739. That is the line. Once that close prints, the false breakdown is confirmed, and the momentum shifts back to the buyers. After the 4-hour close, you do not chase the move. You wait for a 30-minute pullback toward the newly established support at 62,800. That is your sniper entry. Place your stop loss at 62,500, which is below today's Asian session low and beneath the breakout level. That gives the trade room to breathe while keeping your risk defined. Your target one is 63,800, a minor resistance level from the prior consolidation that also aligns with a volume node. Target 2 is 64,125, the major swing high. The risk on this trade is 300 points from 62,800 to 62,500. The reward to target 1 is 1,000 points, a risk reward of over 3 to 1. To target 2, it is 1,325 points, a 4.4 to 1 setup. This trade is voided if the price drops back below 61,800 before your entry conditions trigger. Strategy number 2 is the active trader, a standard setup for those who want to front-run the bounce but with a structured entry. The thesis here is that the Nikkei will not break 61,835 on the first test. That level is too significant. So we place a limit by order at 61,900, just above that support. The entry logic is a bullish reaction at a major confluence of the daily moving average and prior range top. Your stop loss goes at 61,600, cleanly below the support and below the Friday low. That is a 300-point stop. Target 1 is 62,739, the broken support that will act as resistance. That offers 839 points of potential profit, a risk reward of 2.8 to 1. Once target 1 is hit, immediately move your stop to break-even and activate a trailing stop of 200 points. Let target 2 be 63,200, the 4-hour 20-period moving average. That trailing stop rule locks in profit if the buyers lose steam. If the price closes below 61,500 on the 4-hour chart, the entire bullish structure is compromised, and you should stand aside. Now, here is where I want to hear from you. Let's see how aligned we are. Type your Nikkei 225 range for tomorrow in the comment section right now. Give me a high and a low. I am reading them, and I will feature the most accurate call in tomorrow's video. Strategy number 3 is the Aggressor, strictly for those who know how to lose small and manage risk aggressively. This is a counter-trend short that aims to capitalize on a failed reclaim. The setup: if price spikes towards 62,739, perhaps on a headline, but then a 15-minute candle closes back below 62,650, you short at market, 62,650. The logic is a rejection at the resistance, a classic false breakout. Your stop loss is tight, 25 points above the high of that spike, placed at 62,900. That is a 250-point stop. Target 1 is 62,000, a psychological level that will attract some profit-taking. Target 2 is 61,835, the major support. This trade carries a negative risk-reward in terms of the initial stop, but the win rate on such traps can be very high if executed at the right moment. The warning: only size this trade for a loss you are 100% comfortable with. If the price instead closes above 63,100, the short thesis is dead, and you must exit immediately before we wrap the risk management pulse. Never risk more than 1 to 2% of your account per trade. No positions through high-impact news. Stops are non-negotiable. The one most critical level for the next session is 62,739. Watch the 4-hour close relative to that line. It will tell you whether the trap is sprung or whether the breakdown has genuine continuation legs. Tomorrow, we focus squarely on the US ISM manufacturing print and any Bank of Japan response. If the data comes in hot and yields spike, the yen could weaken sharply, and the Nikkei trap will explode to the upside. If the data misses, and dollar-yen cracks 130, the 61,835 test becomes the main event. That is the inflection. You need to be ready if you want the full breakdown on Bitcoin and the S&P 500 divergence. That video is live now, check the end screen. and I will walk you through the risk asset shadow that is tracking every tick in the crypto space. Smash the like button if this analysis gave you a clear plan for the Nikkei today. Subscribe, hit the bell, and I will deliver this same level of institutional-grade intelligence across 8 key assets every single day. The charts do not lie, and I will see you in the next one.